everyone. Welcome to the session Final Accounts for Commerce students. So in final account, we will prepare income statement and balance sheet. So the primary aim of accounting is to assess the business performance. How much the business is performing, about the profitability of the business and the financial position of the business. Profitability means whether the business is running at a profit or suffering from losses. Financial position means what is the assets and liability position of the business. So we know there are 5 key elements of financial statements. One is revenue, another expenses, then assets, liability and capital. Revenue and expenses are 2 elements of income statement, whereas assets, liability and capital are 3 important elements of balance sheets. So in final account, we will prepare one trading account, another profit loss account, then balance sheets. So the main purpose of preparing trading account is to ascertain how much gross profit or gross loss arising out of running of our business. Then from profit and loss, we will calculate how much is the net profit or net loss suffered by the business. Then we will prepare balance sheet. As a mirror reflects the face of a person, balance sheet reflects the financial position of the concern, showing assets on one side and liability on the other. So we know, in case of trading account, we have to take into consideration only revenue item. That is, revenue expenses are taken on the debit side of trading and profit and loss account, and revenue incomes are taken on the credit side of trading and profit and loss account. All capital nature means your capital receipt and capital expenditure will find its place in balance sheets. So before discussing it, we should first clarify which are the items related to capital receipt and which are the items related to revenue receipts. So capital receipt comes from financial activity of the business. Suppose the owner started the business by depositing check of rupees, suppose 5 lakh. That means the capital comes to the business. But revenue receipt comes from operational activity of the business. Once we run the business, out of operation of our business, the revenue receipt comes. Means suppose we will sell goods, some receipt will come to us, that is revenue in nature. Second is, it is the amount realized by sale of fixed asset. Suppose we are selling fixed asset, we are realizing capital receipts, either cash or bank, or in case of company by issuing share, debenture, we will also raise funds, that is capital receipt. And even from bank loan also, we will get capital receipt. Then revenue receipt is realized by sale of goods or by rendering some services. So capital receipt are non-recurring in nature because it incurs to a huge extent. The amount gives benefit for a future period of time, so it is not recurring in nature. Whereas the revenue receipt, it is occurring again and again due to operation of our business, so it is recurring in nature. So capital receipt are source of income. It is source and income. Suppose we deposit, we made any investment, then out of that investment, it will give us some interest every quarter or every month. So this is sources of income. But revenue receipt gives us only income. Then capital receipts are shown on the liability side of balance sheet, whereas revenue receipts are taken on the either credits if it is a direct income, it is taken in credit side of trading account. If it is indirect income, it is taken in the credit side of profit and loss account. Then we should discuss the difference between capital expenditure and revenue expenditure. Capital expenditure results in acquisition of fixed assets. Suppose you are purchasing fixed assets, we will incur some capital expenditure. Whatever asset is purchased, the purpose is not for resale. Our purpose is that it will create further assets and it will give long-term benefits in future. But revenue expenditure incurred for meeting our day-to-day expenses of carrying out our business. For example, payment of wages, salary, electricity, insurance, stationery expenses, etc. Then, in case of capital expenditure, the earning capacity, existing capacity resulting in increasing its lifespan. So, it results in improving the earning capacity or existing capacity of the asset. Suppose we purchase one plant and machinery, then it will generate some production, it will give benefit for a longer period of time, years to year, it will give benefit to us. But revenue expenses incurred for maintenance or in order to keep the existing capacity intact. Suppose we have purchased the machinery, we have to incur petrol expenses, oil expenses for the maintenance of the machinery. Similar, capital expenditure is non-recurring in nature, whereas revenue expenditure is recurring nature. So, capital expenditure gives us long-term benefit, whereas revenue expenditure gives us short-term benefits. Capital expenditure represents unexpired cost, that is, cost of benefit to be taken in future, whereas revenue expenditure represents expired cost, that is, benefit of cost has been already taken. Suppose we are paying salary to the staff, means they have already gave the return to the business. Then capital expenditure shown on the asset side of balance sheet, whereas revenue expenditure shown on the debit side of trading account or profit loss account. If it is direct expenses, it is shown on the debit side of trading account. If it is indirect expenses, it is shown on the debit side of profit and loss account. Then capital expenditure may be incurred before commencement of business. Suppose you are starting a business. Before operation of the machinery, before the operation of the business, we have to incur some expenses, that is known as preliminary expenses. But revenue expenditure only incurred after commencement of business or starting of a business. So, beside capital expenditure, revenue expenditure, another expenditure is deferred revenue expenditure. It is revenue in nature, but it gives benefit for a certain period, say 3 years, 5 years, and it is non-recurring and special nature and is of large amounts. For example, special advertising expenditure for a new product. So, definitely due to advertisement, it will give benefit for more than 1 year, suppose 3 years, 5 years, whatever may be. So, suppose we incurred 3 lakhs on deferred revenue expenditure, every year we will debit 1 lakh to our profit and loss account. Another 2 lakh will be carried forward to next year. Then in the next year, out of 2 lakh, we will debit write off 1 lakh in the profit and loss account of second year. Then finally in the third year, it will be adjusted. Thank you for seeing my video. So in the next video, I will prepare how we will prepare the trading account, profit loss account and balance sheet.